In the world of precious metals, there are signals, and then there are alarms. What we've just seen in the silver market isn't a quiet signal. It's a blaring five-alarm fire bell that most of the financial media has completely missed. While everyone was distracted by the day-to-day price noise, the volatile swings up and down, something fundamental, something tectonic, was shifting right beneath the surface. And it has the potential to rewrite the entire rulebook for this market.
And it all comes down to one staggering number: 29 million. That's 29 million physical ounces of silver, just gone, pulled directly out of the COMEX vaults. Now, for those of you who follow this space, you know the COMEX is the bedrock of the entire global silver futures market. And that bedrock just had a massive chunk ripped out of it.
But here's what makes this truly unprecedented. It's the speed. This wasn't a slow drain over a month or a quarter. This happened in just 4 business days. 4! Let that sink in. This wasn't a leak, it was a deluge. A full-on bank run on physical silver, happening at a speed that suggests urgency, maybe even desperation.
So what in the world is going on? Welcome to the Bullion Signal Podcast, the channel where we cut through the noise to focus on the signals that truly matter for your wealth and your future. Today, we are decoding this massive drain on the COMEX. We're going to look at the sheer scale of it, what I'm calling the fire hose drain. We'll investigate who is behind it, because it's not who you think. Then I'm going to give you a 4-part dashboard of signals you need to be watching right now. We'll explore 3 potential scenarios for where silver goes from here. And finally, we'll build a strategic framework so you can make sense of it all. If you get value from this kind of deep dive analysis, do me a favor and hit that subscribe button. It helps us continue to bring you this vital information. Now let's get started. All right, let's dive right in. Our first section is about the sheer scale of this event. I'm calling it a fire hose drain, and honestly, that might be an understatement. We need to understand exactly what's happening inside the silver vaults.
To really grasp the magnitude of this, you need a baseline. So far this year, on a typical day, maybe 200,000 ounces of silver would move out of the COMEX vaults. That's a normal flow. What we just saw was an average daily withdrawal of 7.25 million ounces. That's not a 50% increase, it's not a 100% increase, it is a 145 times increase in the daily withdrawal rate. Imagine you're draining a swimming pool with a garden hose and someone suddenly swaps it out for a fire hose. That's the kind of pressure we are talking about. It's an almost violent rate of depletion.
Now, why is this so critical? Why should you care about inventory levels in some warehouse in New York? Because the COMEX registered inventory is not just some stockpile. It is the physical guarantee backing trillions of dollars in paper contracts. It's the ultimate promise of the futures market. The promise that if you stand for delivery, if you say, I don't want the paper, I want the metal, that the metal will actually be there. When that pile of physical silver shrinks, the promise gets weaker. And when that promise is questioned, the entire paper market built on top of it becomes incredibly fragile.
Okay, so the next logical question is, who is doing this? Who has the power to pull this much metal off the market so quickly? If your first thought is that this is another Wall Street silver retail movement, I want you to put that idea aside. The evidence is pointing squarely at much bigger players. It appears Wall Street itself is flipping its position on silver.
Let's connect the dots. First, you have the big silver ETFs like the iShares Silver Trust. We're seeing massive inflows there, nearly 590 tons. That's institutional money. Then you look at the major banks. JPMorgan, historically one of the biggest short sellers in the silver market, has reportedly flipped to being net long. That is a massive shift. Add to that a surge of call option buying, essentially big bets that the price is going to explode upward, and even major banks like Bank of America putting out bullish price targets. This isn't a grassroots movement. This is the smart money positioning itself for a major repricing event.
Okay, this is all happening fast, and it can feel overwhelming. But how can you, from your own home, track what's going on? How can you see the stress building in the system with your own eyes? That's what we're doing next. I'm going to give you a simple 4-indicator dashboard. Think of these as the vital signs of the physical silver market.
These are the 4 things you need to watch. Number 1 is obvious, the COMEX inventory levels themselves. How much metal is left? Number 2, silver lease rates. In simple terms, this is the interest rate you pay to borrow physical silver. Number 3 is a market condition called backwardation, which is a huge red flag. And number 4, the Shanghai premiums. We'll look at the price difference between China and the West. Together, these 4 indicators give you a complete picture of the market's health, or lack thereof.
Let's start with indicator number 1, inventory.
Think of this like the fuel gauge on your car. The analysis suggests that once the registered inventory drops below 20 million ounces, we're in a critical danger zone. The market becomes extremely tight. Well, guess what? As of now, we are hovering right around 19 million ounces. We've already crossed that first critical threshold. The next line in the sand is 10 million ounces. If we break below that, we're not talking about tightness anymore. We're talking about a potential market failure.
Indicator 2, lease rates. This is my favorite one because it's so simple. It's the market's fear gauge. When industrial users and banks are desperate for physical metal, they're willing to pay a very high price to borrow it. Right now, the annualized rate is elevated, around 38%. But the magic number to watch is 50%. If lease rates spike above 50%, that signals extreme, almost panic-level scarcity. It's only happened a handful of times in the past couple of decades, and each time it was the canary in the coal mine for a major price move higher.
Okay, our third indicator has a technical name, but the concept is dead simple. It's called backwardation. In a normal, healthy market, a futures contract for delivery in, say, 3 months costs a little more than the price today. That covers storage, insurance, and so on. But when a market flips into backwardation, it means the price for immediate delivery, for getting the metal right now, is higher than the price for future delivery. It completely defies normal financial logic. It's the market's unambiguous way of screaming, I don't trust the future, I need the physical metal today, and I'll pay a premium for it.
And for our fourth and final indicator, we look east to Shanghai. You need to watch the price of silver on the Shanghai Futures Exchange versus the price in London. If Shanghai is trading at a significant premium, say more than 2% above London, that is a profoundly bullish signal. Why? Because it tells you the demand isn't just paper shuffling among Western banks. It means the world's manufacturing powerhouse is scrambling for physical silver to feed its factories. It's a sign of real, tangible, industrial shortage.
Okay, so there's our dashboard. The inventory light is flashing red. The lease rate gauge is climbing. The backwardation alarm is sounding. So the million-dollar question is, what happens next? Where is this all heading? Let's walk through 3 potential scenarios, from the most explosive to the most benign.
Based on the data, we can sketch out 3 main possibilities. Scenario 1, which I'll call the parabolic squeeze, has about a 30% probability of happening. This is the explosive outcome. Scenario 2, the measured rally, is the most likely path, with around a 50% probability. This is a strong but more controlled move higher. And finally, there's always the chance of a correction, about a 20% probability where the market pulls back. Let's break down what each of these looks like.
First, the parabolic squeeze. This is the scenario where the drain on COMEX doesn't stop. Inventory plummets below that 10 million ounce mark, lease rates go through the roof, and we enter a feedback loop of panic. Buyers rush in, trying to get their hands on the last available ounces. But here's the crucial risk you must understand. In a true squeeze, your biggest enemy isn't the price, it's the exchange itself. They have a history of changing the rules mid-game, raising margins, forcing cash settlement to protect the sellers and prevent a complete default.
Now, if you think this sounds like pure fantasy, you don't have to look back very far for a precedent. Just think about palladium in 2020. A very similar physical supply squeeze sent its price from around $1,500 an ounce to nearly $2,800 in just 8 weeks. When a physical commodity market breaks, it doesn't bend. The price action can become vertical. Okay, let's look at the most probable outcome, the measured rally. This is the base case. In this scenario, the price action is driven less by panic and more by a sober realization of the underlying supply and demand fundamentals. The price moves up steadily, perhaps consolidating above key levels like $65 an ounce. The key signal you're looking for here is a stabilization in the COMEX inventory. If the drain slows down and inventory finds a new floor, say around 25 million ounces, it tells you the market has adjusted to the new reality at a higher price, without completely breaking down. But we have to be objective. What could derail this whole narrative and cause a correction? 2 main things. A significant downturn in industrial demand, perhaps triggered by really weak economic data out of China, or a newly hawkish Federal Reserve that spooks all markets. The key warning sign to watch for this scenario is the gold-to-silver ratio. If you see that ratio start to climb back up above 75, it's a strong indicator that silver is losing its momentum relative to gold and might be due for a fall. All right. We've looked at the drain, the players, the dashboard, and the potential paths forward. So let's zoom out and put this all into a strategic framework. I want to boil this entire complex situation down to its absolute essence. So the one core question that I believe matters most.
Because underneath all the financial market drama, there is an undeniable physical reality. The demand for silver isn't just coming from people like you and me buying coins. It's coming from irreversible global megatrends. Look at the numbers for photovoltaics, for solar panels, electric vehicles, AI data centers. These aren't optional luxuries, they are the future of our industrial economy, and they are consuming silver at an accelerating rate. For many of these applications, there is simply no viable substitute at any price.
And this relentless industrial demand has led to a startling fact. For 5 consecutive years, 5 years, the world has consumed more silver than has been produced. The total deficit over that period is over 600 million ounces. So how have we managed? Simple. We've been drawing down the world's above-ground stockpiles. We've been eating into our savings account of physical metal. But as any household knows, you can only run a deficit for so long before the savings account runs dry.
And that brings us to the final critical question, the ultimate question. We just witnessed a drain of 29 million ounces in 4 days. The trend is undeniable. Stockpiles are shrinking. So I'll leave you with this thought to ponder. What happens when the well runs dry? What happens to the price of silver and to the paper markets built upon it when the registered inventory at the COMEX hits zero? That's all for this edition of the Bullion Signal podcast. If you found this analysis valuable, please make sure you're subscribed and share it with someone who needs to hear it. Remember, in these uncertain times, staying informed is your best defense. As always, please be aware that this content is for informational and educational purposes only. It is not financial or investment advice. You should always conduct your own research and consult with a professional before making any financial decisions. Thank you for listening, and we'll see you in the next one.